All right, let's talk about WEC Energy. They just dropped their Q3 earnings, and, on paper, it looked like an absolute home run. I mean, they beat expectations, they raised their growth outlook, and they laid out this huge vision for the future. But the market, the market wasn't cheering. So let's dig in and break down this really fascinating disconnect.
So check this out. On one side, you've got the actual results. Earnings per share came in at 83 cents, and revenue was over $2.1 billion. Both of those were solid beats. I mean, by any measure, that's a great quarter. But then you look at the reaction on the other side. The stock actually dropped nearly 2% on the day. So what gives? And that right there, that's the central question we're going to unpack. What on earth did Wall Street see that made them hit the sell button, even while management was out there painting this incredibly rosy picture of the future? This is really a story of a fantastic long-term vision colliding with a very, very real short-term problem. Okay, so first, let's look at the story management really wanted everyone to focus on. And honestly, it's a powerful one. We're talking about a massive data center-fueled growth explosion. And at the heart of that story is one absolutely stunning number, $36.5 billion. So what is that $36.5 billion? Well, that's WEC's new 5-year capital spending plan. And this chart really shows you the sheer scale of that ambition. The new plan is a staggering $8.5 billion. That's over 30% higher than their old one. Look, this isn't just a small bump. This is a fundamental, game-changing shift in the company's entire trajectory. So the big question is, where's all this money going? The simple answer is big tech. This whole spending spree is being driven by the insatiable demand from hyperscale data centers. We're talking about Microsoft's huge expansion in Wisconsin, Vantage Data Center's Lighthouse campus, which, get this, is directly tied to that massive OpenAI and Oracle Stargate AI supercomputer project. These are not small upgrades, folks. These are absolute game changers for regional power demand. And here's the reward. This is the payoff management is promising investors. All of that spending, it's projected to grow their asset base by over 11% a year. And that, in turn, is expected to fuel a long-term earnings growth rate of 7 to 8%. Now, you might think, 7%, big deal. But for a utility company, that is a fantastic number, way, way above the sector average. Okay, so we've got huge growth, massive projects, fantastic earnings targets. So why the long face from the market? Right? Let's pivot to the other side of the ledger, because it all boils down to one simple but incredibly important question. How in the world are you going to pay for all of this? And here we go. This one little line, dropped by the CFO on the earnings call, probably sent a chill down the spine of every analyst listening. Quote, 50% equity content. Now, to a seasoned investor, that phrase is a massive red flag. It tells you exactly what's coming next. Okay, so let's actually break down their funding plan. They figure about $21 billion will come from their own cash from operations. Another $14 billion, they'll take on new debt. But the really crucial part, the part that got everyone worried, is this last line. They need to raise roughly $5 billion by issuing new common equity. And for anyone who already owns a share, that means one thing: dilution. It's like the company's taking the pizza you own a slice of and just cutting it into way more slices. Your piece just got smaller. So if you boil it all down, the market's worries really come down to these three things. First, that equity dilution we just talked about. Nobody likes their shares being worth less. Second, this amazing growth story, it's back-end loaded. Management was pretty clear that the real acceleration doesn't even kick in until after 2027, so investors have to sit around and wait. And third, there's this big cloud of regulatory uncertainty around their upcoming rate case in Wisconsin, which is crucial for making sure they can actually earn a good return on all this new investment. All right, so we've seen the impressive story from the bulls and the very real concerns from the bears. That brings us to the next call, where we give you our take on WEC Energy. Our official rating on WEC Energy is Market Perform. And here's the thesis behind that rating. Let's be clear, the data center growth story is absolutely real. It's compelling for the long term, no doubt about it. But in the near term, the stock's potential is probably capped by those big overhangs we just talked about, the financing needs that are going to dilute shareholders, and just the sheer execution risk of trying to pull off such a massive, complex plan. So how could you potentially play this? Well, here's a trade idea to think about. Step 1. Just be patient. You wait for a pullback. Maybe it comes from some bad news on that rate case. Or more likely, it happens when they officially announce they're selling a bunch of new stock. Step 2, that could be your entry point to start a long position. Step 3, and this is interesting, to hedge out the general utility sector risk, you could pair it with a short position on, say, the XLU ETF, which is a basket of slower growth peers. The idea is to isolate WEC's unique data center story. And step 4, that's the target. If they can actually pull all this off, we could see a price well north of $125. But remember, that's a post-2027 story.
And of course, we always have to say it. This is not financial advice. Please be sure to consult a qualified professional before making any investment decisions.